We've done it again. We're here for the Rock Center event. Welcome, everyone. Thank you for coming. I'm Dan Siciliano, a professor here at the law school and the faculty director of the Rock Center. I'll do very brief intros, and then we'll jump straight into it. We're going to be talking today about the student loan issues in the United States and talking about whether or not there is a crisis, too big to fail, student loan crisis. And to kind of just jump into it, I'll go from my right farther down. I'm going to start with Rohit Chopra. Rohit is the Assistant Director of the Consumer Financial Protection Bureau. He leads the agency's work on behalf of, and I'm quoting, students and young Americans. He was also designated by the Secretary of the Treasury as the Bureau's Student Loan Ombudsman, which is a specific position provided for in Dodd-Frank. He has testified in front of Congress and has a very rigorous schedule in which he travels and talks to people and lectures, answers questions about student debt impact on the broader economy. We gave him a day pass to Stanford because he manages to hold 2 degrees from the wrong universities, a BA from Harvard and an MBA from Wharton. So we're very glad to have him here. If you've been reading about student debt and student loans and the impact on the economy, you will have come across his name several times, not the least of which is in the Wall Street Journal a little more than a year ago. And in his discussions, if you don't go onto the website for the Consumer Financial Protection Bureau, you should. He has a blog there in which he discusses, among other things, the recent analysis and discovery, in a way, of the fact that the total student debt burden and debt in the United States is much higher than it was originally estimated to be. And I'll let him kind of talk more about that in a few minutes. I'm also very happy to introduce Mike Cagney. He is a serial entrepreneur. My son, who's 12 and often distracted while playing Xbox, heard me say that phrase the other day, and he turned to me and said, "Aren't they really dangerous, Dad?" I said, "No, serial entrepreneur, not serial killer." He's the particularly helpful kind of serial entrepreneur, a very successful one. He's currently co-founder and CEO of SoFi. I'll let him talk a little bit about that in just a minute. He runs overall operations and is in charge of corporate strategy and development. He's co-founder and managing partner of Cabazon Investment Group. It's a global macro hedge fund. And before that, he founded, was CEO and vice chairman, and ultimately chief architect of Finaplex. It was a wealth management software firm that was sold to Broadridge. And before that, he was senior vice president, head trader for proprietary trading and financial products group at Wells Fargo Bank. He did not require a day pass. He has a MS management degree from our own Stanford GSB, where he was a Sloan Fellow, and then spent some time nearby getting a bachelor's and master's from UC Santa Cruz. So welcome, Mike. Thanks for joining us. And then finally, I'm very happy to not so much introduce, but reintroduce, for those of you who see him on a weekly basis, Professor Marcus Cole. He is a bankruptcy, corporate reorganization, and venture capital expert. He's been with us at the law school since 1997. Prior to that, he was a litigator with Mayor Brown. And prior to that, he was a clerk on the 8th Circuit with Judge Morris Shepard Arnold. He is well known as an empirical law scholar, uses a law and economics approach to investigating a wide range of questions, including a lot to do with bankruptcy and reorganization. If you read in that space, you will know him to be a very active scholar, and he is, of course, also a national fellow at the Hoover Institution and a much beloved teacher here at the law school. So thank you for joining us, Professor Cole. So with that, I think I'm going to kind of throw out the first but relatively softball question, and that is there, and I'll let Rohit go first, is there a crisis? And if so, why and what does that mean? Crisis seems like a big word. We even capitalized it on like the intro. Big crisis. What's really going on?
Well, we've been now over 5 years since the collapse of Lehman Brothers and the financial crisis that ensued. And one of the reasons I don't like to use the word crisis or bubble when it comes to the student loan market is that there really is no day of reckoning when things can hit the fan. There's a real problem that we have. There is a lot of attention around the headline number of $1.2 trillion in debt. And people have to think about that a little bit too much. What they should really be looking at is how much debt are people graduating with versus the income that they're earning. And what we see in the data starting from well before the recession, from the early 2000s, that The college wage premium, that is the difference between wages between college graduates and non-college graduates, has widened dramatically, but not because college graduates' wages are rising, it's because everyone else's wages is in free fall. So what we see is that college graduates aren't really earning much more on average on an inflation-adjusted basis, but their debt is growing much faster than their wages, and their debt is growing faster than tuition prices. So one of the stories is not just about tuition going up, but about the fact that families and households don't necessarily have as much money to support their dependent child's education. So I think there's a few key problems. The first being that for borrowers who are doing okay, they have a very difficult time refinancing their debt and getting a lower rate to take advantage of their improved credit profile. And for those who are struggling, federal loan borrowers have options like income-based repayment, but many of them struggle working with their servicers to get enrolled in those programs. And for non-federal loans, the private credit loans, particularly the subprime ones originated prior to the crisis, just like subprime mortgage borrowers, they have a very difficult time modifying and restructuring that loan in order to find a payment that works for them. And all that being said, we now have a generation of people who have a lot more debt relative to their income, and that can fundamentally change the psychology of the economic endeavors they pursue, whether it be starting a small business, buying a home, or otherwise consume goods and services. The National Association of Realtors showed that first-time homeowners are at historically low proportions as of overall home ownership, and student debt may contribute to real difficulties qualifying for a mortgage or accumulating a down payment. So I don't like to use hyperbolic words like bubbles, because it's a bubble that really can't pop, but what we may see is real drag and pain if we don't do something about it.
So I'm going to come back and ask some sub-questions in a little bit, but I think I'm going to skip you, Mike, for a moment, because I'm going to come back to you last and have you tell us a little bit about what you do, because I think that fits in the story. I'd rather turn to Professor Cole and have you kind of answer the same question. I mean, maybe give a different perspective if there is one.
Yeah, so I don't think it's, I also don't like to refer to the situation as a crisis, although for a different reason. I don't think that just because it's not a bubble that would burst, that it's not an incredibly serious problem. I mean, it is a problem in the same way that the boiling water is a problem to the frog that doesn't notice it. You know, at some point, it's going to lead to the frog's demise. And the drain on disposable income that this circumstance is imposing on American families is as dangerous as the bursting of a bubble. There might not be a particular point at which that we can point to as the day of reckoning, but it's still a very serious problem. And I don't think that I think that we're thinking of it as in the wrong way. I think that it is not, in fact, a student loan crisis or a student loan problem, so much as it is a regulatory problem. It's actually a statutory problem that creates a financial crisis, and it's one that's very fixable, in my opinion. But it's one that hasn't received as focused attention as banking regulation or other areas of the financial sector.
Is there a particular statutory feature that when you highlight the problem that you point out?
So we're going to talk a little bit later, I guess, about the distinction between for-profit and not-for-profit student loans, government-subsidized student loans, and privately placed student loans. But in 2005, the Bankruptcy Code was amended so that Section 523 A8 of the Bankruptcy Code did something that we had never done before. Student loans prior to 2005, if they were government subsidized or government guaranteed, federally guaranteed student loans, were always exempt from discharge in bankruptcy. If you took out a student loan, you could not discharge it in bankruptcy. In 2005, Congress amended the bankruptcy code to make it so that all student loans of any sort, whether they were federally guaranteed or not, were no longer dischargeable in bankruptcy. And that created an opportunity, a window of opportunity for opportunistic lenders, as well as a crop of for-profit schools that have operated in conjunction with these lenders to create a new problem that didn't exist before 2005.
Great. We'll definitely come back to that, I think, explore it further. But before we move into some of the details around these issues, Mike, can you tell us a little bit about what you do and how that fits in to this story? I didn't want to kind of cover it in the intro because I figured you could do it best.
Sure, and it fits in a couple of different ways. Fundamentally, what SoFi does is we connect sources and uses of capital, and in this case, we connect alumni dollars with student loan refinancing dollars. And we refinance folks who have graduated. We don't lend to folks in school as much for a variety of reasons that I'll talk about. I think in the context of some of the evidence that Rohit was citing, we created an entrepreneur program for our borrowers, where if you're a SoFi borrower and you want to start a company, we waive your interest payments for 6 months, and we help you with a business plan and actually help you get financing. We've done that for 17 borrowers where we've actually got them started, have started companies. And we did that because one of the things that I saw when I was at the GSB was the number one reason why people would graduate and go into something godforsaken like consulting instead of starting their own business, no offense to those consultants here, is because of their debt. And so there definitely is behavior modification that's coming on the back of the debt burdens that are there. But ultimately, at the end of the day, what we're trying to do is develop community-based solutions that I think in the back end address some of what Professor Cole was alluding to, which is and certainly what Rohit was alluding to as well, there are lots of circumstances out there that you can point to where the cost of the education isn't commensurate with the value. And you see this very pervasively in for-profit private education, much more so than you see in nonprofit, public and private. And the issue is that a lot of these institutions are pushing on this notion that you need a college education irrespective of the cost. They're not providing transparency to what the value of that education is to you. They're enabled by a system in which you can borrow as much as you need to borrow. Whatever the school says you need to borrow, you can effectively get that amount of financing. And there's no accountability back to the school around, did they graduate someone that could pay their debt back? There's no accountability around, did that person find employment? Did they get meaningful gain? It creates a system that's fraught with agency problems, and it really drives the circumstance that we're in today. And so SoFi was originally, and still pursues the model of, if you build sources of community capital, it can go in and instill better behavior. So as alumni, you're going to invest in circumstances where the default rate's low enough to provide an economic return for you. If the default rate's too high, that's a measure to the school that they're out of whack in terms of value and cost of education. And that's what we try to bring to light in terms of the model.
So this is a good opportunity then maybe for me to draw attention to the handout that you have in front of you. So first, I'd be remiss if I didn't point out some folks for the Rock Center. So Jacob Russell helped organize and put this together. Got Evan Epstein, he's a fellow at the Rock Center. Evan Epstein, executive director, and Amanda Packle, who's not here. They run all these programs. They do all the heavy lifting. So with their help, we pulled this together from pre-existing sources. And I think I'm going to ask Rohit maybe to point out some of the relevant features here, perhaps tying a little bit to what Mike pointed out, but also just giving us a landscape, because we're about to ask a little bit more detailed questions about what we think is happening with what segment of the student loan market. Can you tell us what this means in front of us? I'm looking at the kind of one not with the pie charts.
Sure. Just to take a step back, when you think about private capital and public capital's participation in the student loan market, there are really three different flavors. So the most common flavor for the majority of our history has been a government-guaranteed student loan program. So banks and other financial institutions would generally issue a student loan. It was stamped with a government guarantee. The financial institutions would theoretically compete and offer, there was a statutory cap. They didn't really do that. They generally charged the statutory maximum. And the federal government would subsidize those loan holders with guaranteed rates of return. So it's private capital, but with a government type stamp. Think of a little bit like a mortgage that is VA insured or some sort of other government mortgage. There's also direct lending, which is the only type of federal loan that's now being issued, which is essentially the federal government on its own balance sheet is originating loans to borrowers. That is, we are now at 100% direct lending starting in fiscal year 2010, and the rest of the bank-based lending that was government guaranteed is just running off right now, no new origination. And then there's pure private lending. There is no government guarantee at all. This is a smaller part of the overall market. And you have to also remember that people have multiple types of these loans. So our highest borrowing borrowers, those 81% of those who borrow $40,000 or more use private loans and federal loans. Now, what this is essentially showing is the repayment status of the federal loan program. There's over $1 trillion in federal loans. The media likes to talk a lot about how nobody is repaying these loans. In some cases, it's completely fair that they're not repaying it because in the direct loan situation, they're actually in school and they will start paying afterward. But if we look at the FEL line, this is that government guaranteed federal loans, we actually see some real hardship of the status people are in. Some of these loans are quite old, but they're in forbearance, which is the most common type of forbearance is a hardship forbearance, or they're in default. About $60 billion is in default.
So am I reading that correctly? So roughly 1 out of 4 of the dollars in that first top part are in default. So they're either not in default, in either forbearance or default. Is that right? So
that would be right.
Okay.
That would be right.
So 1 in 4 dollars in the FFEL category.
And the reason why this is very troubling is federal loan borrowers can very easily avoid default. There's income contingent repayment, income-based repayment that allows you to pay as low as $0 as a percentage of your income. In the mortgage market, we saw some very alarming problems with mortgage servicers, where there was established programs for borrowers who were in trouble to get loan modifications, and we saw repeated failure after failure after failure and lots of law breaking. And this is something that we worry about too with loan servicers in the student loan market, particularly those who are servicing these FEL programs who may not have the incentive to actually do these loan modifications even though it's a legal entitlement.
Let me ask a follow-up, which is a little bit more about the future, because the direct loans now is kind of the future where we see what's going to happen. If we look, again, I'm looking at the top, it's in the billions of dollars. Under direct, default is 5% and forbearance is 8%, but a much larger portion is in school. Is your estimation that the direct lending category is roughly headed in the same direction as the FFEL, meaning as people leave school, exit grace period, enter required repayment, they will then over time fall into the forbearance and default categories at roughly the same ratio, or is it different?
Well, if they do, that would be a huge public policy failure. So the first issue is that one of the key drivers of performance is going to be the conditions of the labor market for young college graduates. So if they're able to land jobs fairly quickly, you'll probably see better performance. And if you see servicers do their job and enroll people successfully in income-based plans, you won't see such dismal performance in my view.
I think it's important to add to what Rohit said. With a federal loan, it is nearly impossible to default if you follow the guidelines of that loan. And that's why we encourage folks when they come to us and they want to borrow in school, we actually encourage them to take a federal loan in school because it has so many borrower protections and you have so much uncertainty when you're in that journey about where you're going to end up when you're done with school. And we see this all the time, and it's not surprising that message isn't being communicated through. So we'll have folks that will come to us that want to refi who make $35,000, they have $100,000 in debt. And we look at this and say, well, not only can we not refinance you, but you need to be on an income contingent or income-based repayment plan because it's the only way you're going to manage this debt load. And when we deal with the servicers, when we try to refinance people's loans, they're always very slow in doing it. If someone pays down, let's say they have two loans, say a 6.8% and a 7.9% loan, and they'll pay $50,000 to pay down the 7.9% loan, the servicer will apply it to the 6.8% loan. And we'll go and say, you applied it to the wrong loan. We'll just constantly go through these processes. So the idea that there is an education there for borrower protection is certainly not surprising. But what is, unfortunately, the reality here is you have this 5% direct and 14% FFELD default numbers that should be zero, because you have enough borrower protection in these programs, you shouldn't have any default.
Yeah, 4.4 million people are in default on the FFEL loans. And so something seems very broken. And you've described the servicers as clearly a part of that story. Maybe, Professor Cole, you want to chime in, but I want to drill down a little bit on what seems so broken.
Part of the problem with these numbers is that it conflates apples and oranges. It's bringing together student loans that have very little, if anything, to do with each other. A lot of the default that we see in the student loan market isn't the student who goes to Princeton and studies philosophy and then can't find a placement. That's not what's happening. What's happening is when I testified before the Senate Judiciary Committee, the woman sitting next to me took out loans of something like $180,000 to attend a cosmetology school from which she never graduated, and is now on the hook for the rest of her life because she can't discharge it in bankruptcy, $180,000 in student loans. And the problem is that the cosmetology school, once they get that money up front, is completely disinterested in whether or not she can graduate. And they sell her a bill of goods on her future career as a beautician without regard to whether or not she's ever going to graduate. And the lenders who are lending to her are lending to her knowing that they never have to fear not being able to collect this money. Neither the schools nor the lenders have any skin in the game. So what's happening is we're creating this side market that doesn't really involve the top 150, top 200 colleges in the United States, where recent studies demonstrate that it's a good investment to go to college. I know this might upset Peter Thiel, but the fact of the matter is that it's actually a positive return on investment to take out student loans and pay for a college education at the top 200 colleges in the United States. What it isn't a good investment is to take out a loan for a career in an area where it's not demonstrated that they're going to be able to generate the kind of income that's going to be able to pay back these loans. So to mash all of these numbers together and say that we have a 24 or 25% default rate is misleading, because it doesn't address the real problem in this particular market.
So if I can jump in here, what's not included here is some analysis about who is defaulting. And what's so interesting compared to every other consumer credit product, generally speaking, people with larger balances are more likely to default. And we actually find something opposite in student loans, is that the average balance is actually much lower, which suggests two hypotheses. One is that somehow people have a crisis at some point after they've graduated and it ruins them. Maybe that's the case, but I think the more likely scenario is that defaults are disproportionately happening to those who do not complete college. So they have the debt, they really don't get much upside in the labor market. And what Professor Cole is talking about is right. The alignment of incentives between school, the loan servicer, the loan holder or creditor, it is all distorted. And for those of you who are law students, or if you study at the GSB, one of the key things you all will need to confront is that when the next recession or financial crisis occurs, to create the commercial law structure that is more durable. So in the securitizations that occurred in banking, where a loan originator could give you a loan which they expected you to default upon, but they still made money because they sold it up and was securitized. Those trust documents are not very flexible. They didn't consider all the different scenarios, and this is really where finance, public policy, and the law need to intersect and learn from those mistakes, because in mortgage and subprime auto, student loans, we saw all those distortions, and it's something that we need to clean up because the damage on individuals is very, very severe.
So I want to ask a follow-up then and analogize, and feel free to say, no, this is the wrong analogy. It feels a little like, the story that was every house owned by an individual is a good story. We now, after that, we look back and we realize, not every house owned by an individual was a good story. House ownership as its own goal by itself is more complicated than we thought, and it's really made difficult if you borrow in that story. So we now have a little bit of a momentum, socially and otherwise, that goes something like every college attended is a good story. But what we hear Professor Cole saying, for example, and you to a certain extent, Rohit, is that colleges attended of low quality, and some colleges attended of low quality, and colleges attended and not completed, if you're borrowing, that probably is not a good story. So my question is there either a market or a policy fix that really gets at that? And what's preventing that from coming about?
And the analogy is, I think, the problem. This is a credit market unlike any other, right? If you want to borrow money to buy a house, you can't just walk into a bank and say, I'm buying a house for $1 million, lend me $1 million, and you have my word that you'll get repaid. No, the bank will determine whether or not the home has value, and whether you have an income stream that can generate the payments so that you can service that loan. So they both determine the loan on the quality of the asset and your income. The same thing is true for unsecured credit. If you want to take out a credit card, that credit card is issued against your current income stream as well as your assets. Student loans are unlike any other because basically a student has no assets, right? And they have no income. They're a student. They're hoping to generate a future income stream. You're asking a lender to lend against something that doesn't exist right now, but against the prospect that you're going to generate a future income stream. So this is unlike any other mortgage or unsecured credit. And because of that, that's the principal reason why student loans are non-dischargeable in bankruptcy, is because the only thing that creates the market is the lender's belief that this loan can never be discharged. They never have to worry about the loan ever being discharged. It's because of that we can't think of this like a mortgage market. But it's also the reason why we need to start asking lenders and the institutions themselves to have some skin in the game. So my proposal would be to have a student loan, to amend Section 523, to have student loans dischargeable to the extent that they exceed some percentage of the average future income stream of graduates of that institution. This would do two things. First, it requires the institutions to take their educational mission seriously, because if they're graduating people who can't get jobs and can't generate an income stream, then they're not going to be able to get tuition paid through student loans. It also requires lenders to do something that they already do with mortgages, they already do with car loans, and they already do with credit cards, and that is investigate whether or not this borrower is going to be able to repay this loan in the future. And right now, they don't have that incentive.
So Mike, how come we can't scale your methodology to solve?
Well, I think I'd have a question for Professor Cole, which is, would you apply dischargeability to federal loans?
I would apply it. Well, the problem with federal loans is, up until now, the guaranteed loans and direct loans is that they're not truly market based, right? So,
sure.
So they're a different category altogether. I don't have a problem keeping those under the exception of 523, but again, the federal government isn't. You don't have the concern that the federal government is behaving the way some of these other market actors are behaving.
Mike, could you explain why you ask? I think that's relevant.
Well, federal loans are 93% of new loan origination right now. So private loans are only 7% of the market. We can argue about whether they're in the high balances or low balances. Although you're right, the high balances default less. We see that all the time with our business. So I don't think you can create a meaningful change unless you address how the government's lending, because I think the government they're lending a subsidized product. It's perceived as a public good. That's understandable. Everyone gets that. That's okay. But the challenge is that if there's no accountability to the school, right, the school is incented to behave poorly. And to the extent that you restrict private lending, you're still not going to address the core issue because you still have most of the lending coming out of the direct program. I think you would absolutely impact how the government looked at this business if you allowed dischargeability, because the government, when they create a student loan, and this is the goofy thing about how the government accounts for student lending. So when they do a student loan, they take the present value of that loan coupon discounted at the treasury rate. So if you're a finance person, you know how discounting works. And the reality is you can look at these numbers about how much is in repayment. You'd say, well, why would you discount it at the risk-free rate? Obviously, these loans are not risk-free. But that's what they do. And so consequently, if the government books a grad plus loan, they book a phantom gain of 50 cents on the dollar. So they lend you $1. It looks like a 50-cent gain that goes right into the budget, all right? And it's goofy. And if you allow dischargeability, somehow you'd have to have accountability to the fact that you never realized that money. If the government was a company and you're a hedge fund guy, you would short the heck out of them because they're showing all kinds of gains with no dollars to commensurate to that. And that's, if you talk about a bubble or what the issue is, it's not a bubble like the real estate crisis where you have an over-levered financial system and the underlying credit being bad, right? There's a different kind of challenge here, and the challenge is the government has a lot of loans on their books that they book gains against that may or may not realize the economics, and allowing dischargeability would change that. And unfortunately, it would change it for the worse for all the borrowers because they'd have to raise the rates. And so I think it's a very sticky situation, but I think there's a lot of emphasis on private lenders. There's a lot of emphasis on loan rates. At the end of the day, it's just getting schools to charge what the value of the education is, right? And you said poor quality. It's not good schools, bad schools. I can tell you, what do you think is the number one? And I'm going to get in trouble for saying this. What do you think is the number one major that defaults here at Stanford? It's not comp sci.
It's not philosophy either.
It's not philosophy. It's not art history. It's law. Number one default category in student loans.
What is that rate of default, though?
Well, default rates are not reported on student loans in any financially standard way. So I
can tell you it is.
I just want to make just a few things. Where I think we need to start shifting the conversation is, of course, it's a good idea to address tuition and school quality and aligning incentives. This does squat for the 40 million people who currently have student debt. And I'm all for reforming the incentives and aligning it for future borrowers, but our policymakers are so obsessed with that they're not looking at the much larger population which graduated in a very difficult economic environment and is very much struggling to keep up. Now, as it relates to bankruptcy, there's a little bit, I think, too much focus on the bankruptcy code in some ways, because many young people who are struggling are not going to want to go through that process because it's extremely damaging to their credit profile. They might not even be able to get an apartment, pass a job verification check, or ever buy a home. Really, we need to be facilitating a lot more loan modifications and refinancing activity so that borrowers who are doing well can get a lower rate, and borrowers who are not doing well can avoid default and all the consequences that go along with that. On federal loans, there is a bankruptcy-like Chapter 13 style payment plan, which is basically income-based repayment. It's extrajudicial. So in some ways, that is a good, it's not an exact substitute, but for a borrower who's just out of college, that is a perfectly good option and a much better option than bankruptcy. What's curious about this marketplace is that in 2005, the Congress changed the bankruptcy code and overrode existing contracts which were made when the bankruptcy code was different. And one would expect that when the bankruptcy code became more restrictive for borrowers and more friendly to creditors, that prices would go down. But our empirical analysis that we reported to Congress with the Department of Education showed that prices actually went up on average, after bankruptcy code was changed. Basically, the reasoning is that even though there was a downward pressure from the bankruptcy code, there were so many other factors that are going on in this marketplace that have more impact on pricing, and that the market is not totally competitive. So bankruptcy needs to be one part of a portfolio of issues where we are finding solutions. But again, I think it's wonderful to talk about the future and new students, but we really need to focus on the 40 million people who are battling their debt today.
In about 5 minutes, we're going to switch to open-ended questions, but I want to press you on that just because I think you have to wear your ombudsman hat, right? And that focuses on the current debtors. But won't we reincur almost the same amount of debt that we have now in the next 12 years? And then won't that debt be even more interesting because a higher portion of it will be income-based repayment? So that if the next $1 trillion is borrowed in a payback scheme that is income-based, then the lifetime impact will be substantially higher for the next, $20 million or 20 million borrowers who will borrow as much as the previous 40 million. And since it's income-based, if they pay into an overpriced or bad information system, you end up allocating the next trillion really badly. I'm just trying to. I think there's a couple of responses,
the existing debt, the vast majority is also income-based. But I think it's really the broader macro trends. We have a very large group of people, and the empirical literature shows that when you graduate in a bad economy, it sort of screws you for life. You actually don't really catch up to the people a few years prior who graduate in a good economy. Actually, you can look at statistics even at Stanford GSB. The average wages of people who graduate just before Lehman were just so much higher than people after, and if you track them, they don't catch up. So hopefully, as the economy, which we hope, and labor market improves, and it looks like if we believe, the current yield curve, and the current yield curve shows that the market believes that the economy is improving over the 10-year horizon, that those people actually will be better off. And I'm not saying do one or the other, but I constantly feel that we're ignoring the 40 million instead of having a balanced approach.
Yeah, I do want to say one thing about that balancing act, and that's that we can talk about loan modifications and refinancing, but unless you have a backdrop against which there's a threat of discharge, then those refinancings aren't going to take place, right? So, and we see this with municipal bankruptcies in Chapter 9. Since there's no threat of discharge, you can't really get the pressure, or you don't create the incentive structure for the negotiations to take place. And the same thing is true with student loans. So unless we create this, after hearing Mike Cagney talk about this incentive structure with the government, I'd be in favor of having government guaranteed student loans dischargeable as well, because it would correct the incentive structure.
First of all, I want to translate one thing you said in case people haven't taken bankruptcy, and that is municipal bankruptcies, for example, certain pension obligations, other types of obligations are not easily dischargeable. And that's what you mean is in that backdrop, it's very hard to
have a negotiation where there's no threat.
I just want to make sure that we have the same thing. So before we switch to questions, I maybe want each of you to take a minute or two to highlight and you might have covered it, so you can reiterate if you like, the biggest point of misunderstanding that you see in the debate, or maybe a fact that's carried around, and I'll actually start. So not advocating one way or another, but one of the things that drives me a little crazy is the income differentials that are highlighted now. Certainly there's compression between high school graduates and college graduates, and that's compressing, but one of the things that's left out, and I think it's an area for exploration, is income volatility. It's a fancy way of saying, because of the way that cohort analysis was done, it was taken of all employed individuals in that category, it leaves out the fact that a higher ratio of high school only graduates are actually unemployed. And people would rationally pay a premium to have perhaps not as high of overall income over time, but to have less volatility in that income, job security in other words. And we know that the persistence of job security for college graduates has actually grown, not because it's gotten better, but because everyone else has gotten worse. So I throw that out as my pet peeve of what people misunderstand. I think there's another factor there, and a lot of people would say, I've gladly paid $30,000 extra in my lifetime to have a lifetime expected unemployment rate of 3.2% instead of 7.9, for example. I'm not saying it dominates the debate, but it's an important point. Rohit, your turn.
Yeah, no, I think that there is an insurance policy value of a college degree. I guess what I would point to is that so many people are very eager to blame colleges for the growth in student debt. They're a major culprit, don't get me wrong. But one of the major reasons that overall student debt for the average borrower is growing is because the change and weakening in household balance sheets. Starting in 2007 and the years ensuing, you see parents that were upside down on their mortgage. They lost so much value in their home. They might have lost so much value in their retirement account. They might have individually dealt with unemployment, depleting their savings. They can no longer use home equity loans and other borrowings from friends and family. So even though maybe some schools are increasing grants and scholarships or the government is helping, the average debt is growing now faster than tuition. So this is an issue that we have to confront, that it's not just about schools, but it's about real issues with wages of the vast majority of the public for their families to support their dependent child and afterward when they leave.
So I think, and I'll go back to blaming the schools. I think that there's so much attention paid to the symptom and not the cause. And we have all these debates about lowering loan rates by 1% or increasing loan amounts, and none of these matter if you're taking $100,000 in debt out. And at the end of the day, you just have to look at, why are you taking $100,000 in debt out? Forget about the school accountability and everything, which is going to be extremely hard to do. They're extremely effective lobbyists. I don't know if any of you ever heard me get in the debate with the head of financial aid for the UC system on NPR, but she basically lambasted me that it doesn't matter how much debt you take because you all get income-based repayment at the end of the day. That's a pretty poor argument against that. I think the number one thing that could happen is just basic information and financial literacy. So when you come in and apply to a school and you get a financial aid packet, someone should just sit down and explain to you, if you go into this major, here's what your career prospects are, here's what it pays, here's a reasonable amount of debt you can take down to finance that education. And you decide. And if the school's charging way more than that, you can decide. And if the school's charging less, that's a great deal. But just that basic level of financial literacy. And you could say, well, you're expecting too much for a 19-year-old coming in. I don't know that you are, but at the very least, just give them the information, because the schools absolutely resist doing that right now. Why do they do that? Why don't they want to give you that data, right? It doesn't make any sense. And so to me, that's the biggest problem in the market.
Mike, can I ask you a sub-question before I go to Professor Cole? So I am told from a fairly reputable source that by using big data analytics on both Facebook metadata and subdata and Google data for an individual who's 19 years old, right now you can predict over the next 2 years not just whether or not they'll buy a car, but what type of car they'll buy, and then what color it'll be, and a wide set of features within a very high confidence interval, like 80% confidence interval. So it seems, and you deal with data a lot, so I'm asking you this question. It seems perverse that big data doesn't help us with this. Like, it seems like a 19-year-old who's selected within a range, a couple of majors, and has a profile, certain momentum, that they can't get like a Monte Carlo simulation of their likely income outcomes. Is there technical barriers?
Well, no, but the issue that, so what you're talking about would help a lender underwriting in a private loan market. Okay. It wouldn't actually help the borrower from a decisioning standpoint. So for all kinds of reasons that we can go into in terms of behavioral economics, that you never consider yourself the median of a curve. But
we're
yeah,
all above average.
It would help in a risk-based underwriting market, but that's not what's there.
But it doesn't solve the information problem.
Right.
Okay, no, that's helpful. Professor Cole.
So I just have one last thing to add, and I think that we should keep an eye on some real structural changes in the market for building human capital. So I want to expand the concept beyond the student loan market and think about the human capital market. And we're starting to see in Europe a venture capital market emerge in students, where investors are taking out a stake in the future income. It's something that's always been done by soccer teams, but now engineering students and other kinds of professional students, law students, are getting financed in schools that way. And we also see that occurring in the elite universities in the United States. Places like Princeton, Harvard, and Stanford is now tuition free for a lot of their students, if not all of their students, in large part because they've developed a new financing model where they can project with tremendous confidence how much of a return the alumni that are generated from this system are going to give back to their. So we shouldn't think of this as a static problem, because the market is changing.
Well, we have 10 or 12 minutes. If you could come up to the microphones for us so we capture it and everyone can hear you well, we'd appreciate it. We'll take a few questions. I think we have time for 2, 3, or 4. Yes?
My question is sort of multifaceted, but my first question would be, do we have any idea sort of what level schools are representing the most default? And I guess specifically, I'm thinking about creating accountability for universities in particular, and I'm thinking about, for example, the lower tier law schools whose graduates are saying, no jobs at all, are very different than the lower tier medical schools who basically, if you graduate with an MD, you get a job. So I'm wondering if there's a way to link the accountability back to the schools who, a lower tier law school, all of their faculty are getting paid 6 figures, and, they're making a lot of money on this endeavor where a lot of their students are ending up in a very bad position.
Who would like to take that?
Well, the data would suggest that by sector, defaults are disproportionate in 2-year community colleges as well as all of the entire for-profit sector. Completion rates in both of those categories are generally quite low, meaning people don't attain that degree. But I think what you're raising is a very, very important point generally, which is I can find information on complex derivatives more easily than I can find key information on student loans. There is a real problem with opaqueness in this market, that the public lacks key data to make data-driven decisions from policy and from underwriting, because we do not know by school, by major, by bank, all of these factors that we know in other markets, and demographic data and how those folks perform. And without that performance data, we are not going to be able to productively bring private capital in and make it more efficient. And it's something that people interested in the law, public policy, and finance should all be very concerned about.
I would ask you to look at this from a community base. The biggest employers, the most vibrant employment you can have is university and medical, anywhere. And once that's in place, the dynamics are so rigid for perpetuating it that you don't need to be a lobbyist, you just need to be a local taxpayer. So it's so much broader. And I've worked with federal programs for retraining and replacing high-tech workers. And the collusion between commercial training, state and federal programs to just move the bodies through is horrific. And so the larger pieces are, well, what is the collective myth we're operating under? And that is, we will put people through training with no knowledge, and because no one has it anywhere in the world, of what are the jobs really out there and what are they going to be. And in the absence of that, we can have this ongoing community of vibrant services and engagement, and parallel a completely indenturing system for our youth, who come out passive, necessarily cautious, and unable to do the kinds of organizing that might lead to systemic change. So I just ask you to look at it, and where that looking tends to be held in this policy educational programming, to look at the myth that is helping us sustain ourselves through a declining economic position in the world, et cetera, et cetera. So, you know, where do you get unemployment? The humanities. Stanford and everybody else has huge sunken stuff.
I'm going to ask Professor Cole to comment on that very happy question. Maybe in a bigger sense, I'm going to generalize it, which is there, in your mind, thoughtful analysis happening at the academic level to kind of tease out the empirical allocation of efforts for retraining, right? It's not just student loans, it's a signal for other things. Do you have a sense of where that's going? And you can jump in, Rohit, if you like.
So whether there's
public policy side.
There's active academic.
Well, it's kind of a big question, right? So where, we have this huge machinery in place that endeavors, I think, with good intentions, to move people through training programs, through community colleges, we have a lot. It's not just the student loans. There's a lot of stuff trying to push people in that direction to improve human capital, but sometimes it doesn't come out right.
Yeah,
and
so it's interesting. Yesterday, the Conservative government in the UK announced. I'm sorry, not the Conservative government. The Labour Party in the UK announced that they are proposing a plan whereby recipients of any public welfare have to go through. They either have to have employment prospects or and pass an examination in math and science, or they have to enroll in training programs for math and science. It's a proposal that they put forward yesterday, and it's trying to get at this idea of investing in human capital. Now, I'm not in agreement with their proposal, but what's interesting is that they recognize that there's a gap between the spending on human capital and the actual growth in human capital. And so I think that at the end of the day, we have to have some accountability by educators, colleges, professional schools, trade schools, as to what they're producing at the end of the day. The objection to this is that what we're creating is a professional school environment, and we're abandoning traditional education. But
it's a topic worthy of its own session. So thank you.
So there are some situations where the fault for the mishap of the investment for the education not translating to future income can be allocated perhaps more specifically to one or more players, certainly away from the student. One example is students going to an unaccredited college that then closes, and so you don't get your degree through no fault of your own. And you end up with the debt, and it doesn't translate to increased income. So I guess I have kind of a twofold question. One is, are there other examples of these carve-outs that are perhaps where the solution is perhaps a little bit easier to tackle than a system-wide solution with fixes? And is it a good policy or a good strategy to tackle the carve-outs to get rid of most of the worst problems rather than tackling the entire system?
That's great. So whether special circumstance dischargeability or parsing the biggest problems first, what do you think?
Before we answer, I was just going to point out that if your school actually shuts
Closed.
down, your debt's discharged.
Your federal debt is
Federal debt's discharged. So it's a...
And to your earlier point, nowadays that likely constitutes a large portion of the debt. Is that right?
No, closed schools are a very small amount of debt. I would say those, if I'm understanding your question right, those special circumstances, people becoming permanently disabled or their school closes, these are highly marginal situations. And there are currently statutory provisions in place to address those on the federal side. So they do actually discharge that debt, and it's not a very large volume. I guess I would say, for those of you interested from the law and policy perspective, there is currently a proposed rule that will soon come about in the next month or two that will seek to disqualify certain for-profit providers of education from the federal aid programs if they do not meet certain performance metrics. So for example, if their students leave with too much debt or other types of factors like that. In my opinion, it will be interesting to watch and see how the public comments on that proposal. It's certainly a sector where people are experiencing a lot of hardship. I do think, though, that there is still a significant issue of borrowers who are doing okay. They are making their payments, but they're perhaps paying rates that are well in excess of their risk, and they have a very real challenge refinancing it. Mike's company is one of my regulated entities, so I'm not endorsing him, but that sector of refinancing loans is one that the federal regulators are happy to see emerging, because it appears to be a way for private capital to increase competition in the market in a real productive way.
Rohit, can I ask a sub-question on that, which is, are you concerned that it'll be overly blunt? So, for example, if you further regulate and disqualify in the way you described private for-profits, you might accidentally cause an emerging for-profit that blends free online education with some direct education, and it admits a cohort that has very high failure rates. But the average debt load is very, very small. Maybe it's like $5,000 because they've created this really clever blend, but their default rate ends up being 50%. So the language that I've seen bantered about doesn't do a really good job of trying to address scale. So for example, I would think that in some ways, an innovative system that admits people who might not otherwise be admitted into higher education and has a 50% failure rate, which is really bad, maybe a 6% failure rate and a 50% non-pay rate, but only indebts people up to like $3,000, might be better than someone who has half that failure and default rate, but it's $40,000 or $50,000. Do you think that we will be careful enough in the expansion of regulation not to accidentally stifle what seems like lots of innovation coming through the pipeline? I mean, it's like almost there in the delivery of the education products.
Well, I mean, I'm not going to comment on, open rulemaking. The Administrative Procedures Act provides for a process to contour those things, sure. And rulemaking is a very difficult thing. That being said, I don't think that any school should be entitled to get federal grants and aid. There has to be some sort of way of proving yourself that you are worthy of that. And now, I think it's particularly alarming. We have tens of thousands of veterans, largely in their 20s, Iraq and Afghanistan vets who are legally entitled to the post 9/11 GI Bill, which is very generous. And I'm concerned that many of them are using those funds because they're being aggressively marketed to by many of the for-profit colleges. They're finding that college is not providing them the value that they wanted. They are losing that benefit, and then they're racking up lots of debt as they start over. And that's, to me, not something that is appropriate. And we should make sure that, particularly for veterans transitioning back to civilian life, pursuing post-secondary education, that they're getting good quality programs and not being duped.
So, Mike, I'm going to let you ask the last question, and we'll hang around for a couple minutes, some of us, but we're running out of time, and
You raised two things. One is the information. The other is the load on society. Question is, what would it cost to make publicly available on the internet the information that we really need as individuals to determine whether this school is better than that? $25 per student per year, $5,000, that type of thing. And secondly, if we wanted to reduce the load of people in the society, if we made this refinancing frictionless, would that solve 90% of the problem or 12%? That type of two questions.
I think Mike and Rohit, this is for you guys.
I think on the refinancing side, it's still a very small amount of total outstanding borrowers. And the reason being is that, and this is where we've vacillated in terms of how the government can get involved and facilitate. The capital markets still have barely opened up for student lending. And so we're the largest student loan refinancing entity out there. We did the first securitization of a peer-to-peer bond in the marketplace. And it's been very hard to unlock that capital market and deliver that value proposition. So what we had to go to the market first was an incredibly compelling borrower set. So we have over 4,000 borrowers that have 2 years of vintage with us at this point. We have 0 default. And if you think about that in the context of student lending and consumer lending, that's crazy, right?
That doesn't help.
Well, what it does is it starts the market, it opens the market. The reality is, I think that of the 1.1 trillion that's outstanding, I think there's about 200 billion of debt that you could go out and refinance into a lower rate, but the market isn't ready to take that yet. And this is where, you know, we've argued, look, the Fed had a TALF program to kickstart credit card securitizations again. Why don't they have one to kickstart student loan refinancing? Because it's a public good, it makes sense, and it's still driven on economic fundamentals. And so I think there's a very significant opportunity to what Professor Cole was talking about earlier in terms of addressing debt service burdens on households and reducing those debt service burdens. This is a big push by the CFPB because you can meaningfully change the amount that you're paying into that debt load. But the market's still not ready in a way that's going to have a meaningful impact on large numbers of borrowers.
Rohit, you get final word on cost of transparency.
Yeah, I think, you know, we've tried to do a lot. We created with the Department of Ed this single-page shopping sheet that 2,000 colleges, I believe not including Stanford, have signed up to do, where school borrowers can look side by side about their projected debt, what they, you know, other key indicators. That being said, we always have to be careful about disclosure as a remedy and transparency as a remedy, because there's a tendency to just want to vomit words at people. And when people see so many words, they kind of tune it all out. And think about the process of buying a car. When you're at home, you can make the comparisons, you can shop. But once you're with the dealer, the entire dynamic changes. And I think many young people or people who have been historically disadvantaged when faced with a recruiter from a certain college, that might be a different environment where they might feel pressured to sign up. So it's a real challenging, it's a very challenging situation, and it's one where we might have learned a lot from subprime mortgage lending and ways in which we've tried to make some adjustments to fix that process into how we might address it for young people taking on a big risk.
With that, I want to thank Professor Cole, Mike Cagney, and Rohit Chopra. Thank you very much for spending time with us. Thank you for coming.